We're going to get right into the questions. We've got stacks of questions from our viewers online, and I'm going to try and get through as many as I can. So, Tamryn, over to you. A great question from Sean Griffiths. Basically, he's saying there's been a great deal of press regarding excessive fees and performance fees and random benchmarks. How do you answer this? Why do you think our benchmarks are appropriate? And maybe if we want to add to that, Tamryn, maybe for the viewers, talk a little bit about the difference between a composite benchmark, a peer group benchmark, and the different benchmarks.
Okay, cool. So I think I have spoken quite a bit about fees and the way in which they're structured and how they've kind of vary up, but sort of very importantly down. And in one of those slides, I said, the key elements of a well-designed performance fee structure is choosing a fair benchmark. So thanks, Sean. That's a great question because I didn't really get it. I was already eating into Duncan's time, so I didn't get an opportunity to talk about benchmarks. So there are sort of three main types of benchmarks you can use, and I'm going to sort of use the one that we do last, which is the peer group benchmark. And I'll start off with one option is an absolute benchmark. And it's an interesting question because a lot of clients will say to us, why not just use, if we think it's right, the fee should vary up and down, but why not use the benchmark against which we really care about, which is whether or not the fund delivers absolute returns. And to be clear, we're using a benchmark which we think is a good proxy for determining the fee. Doesn't mean that just because we don't use an absolute benchmark that we're not aiming on delivering absolute returns. And that's why when you look in the Balanced Fund fact sheet, you can see that CPI inflation is one of the measures against which we compare the performance of the fund. And since inception, I think we've got about 10 real. But over the last 10 years, it's varied from 3 to 5 real. So Duncan would absolutely say that he is aiming to generate real sort of solid positive returns over time. That's a very important underlying objective of the fund. But I wouldn't use an absolute benchmark to determine the fee because, whereas inflation stays pretty constant, with a fund that can go 60, 70% in equities, there are going to be times where you're going to get remunerated just because you're basically invested in equities when the fund shoots its light out. And so maybe over long periods of time, it's okay, but there are going to be lots of periods in the short term where that's going to be a very low hurdle against which to compare your performance in a period where equities is doing really well. So that leaves us two other benchmarks, and those are kind of most commonly used sort of types of benchmarks in the industry. The one is a composite benchmark, and the other is a peer group benchmark. What I would say is there's no such thing as a random benchmark. I mean, there's certainly sort of conversations around random benchmarks, but for all fund managers that are regulated within the industry or any fund manager that's doing this, every single benchmark is independently calculated and verified by a third party. You can't really just choose your benchmark, and kind of even if you could, we wouldn't be doing it. So then we look at those two choices. There's a composite benchmark and a peer group benchmark. A composite benchmark would just be taking all the kind of various different indices. Let's say it's JSE and it's like MSCI World and bonds and cash, and it'd be sort of creating a composite which is based on the underlying, let's say, static asset allocation weight. So maybe it's the limits that we're allowed to invest in the fund. And then so it would track the passive index kind of performance over time. And that's certainly one way of doing it. The other way, which a lot of managers in South Africa have done, mainly because of Regulation 28 and the fact that the exchange control limits have changed, let's say 5 times over the last 15 years, is you've used a peer group benchmark. And peer group benchmarks essentially represent the average of your peer group. But the peer group benchmark we use is market value weighted. So it's actually it sort of weights the performance of the larger managers. And despite the fact that, there's this common perception that, if you're big, you can't generate outperformance, actually the evidence shows the reverse. So the larger managers have actually generated better performance and more consistent performance over time. So the market value weighted benchmark has been a much higher hurdle. The other benefits of using the peer group benchmark over the composite benchmark is that it's actually kind of easy to sort of invest in as an alternative because, you can just invest in any of the other managers. It's kind of easily understood and it's measurable and it's sort of freely available. But those are the two benchmarks you can use, and you can say, okay, well, if those are the two, what's most important is, the one might be simpler and easier to understand, but if it's represented a lower hurdle or reference rate over time, then it's not a good benchmark. But actually, when you look at the two, The composite benchmarks underperformed more recently. In other periods, it's outperformed. But over kind of 3, 5, 10-year periods, the differences are actually minimal. So they're pretty much in line with each other. And that's why we've chosen the peer group benchmark. But really, it's a little bit like our fee structures. You continually review them over time. You make sure that it's appropriate and you adjust it if you need to. And obviously on the fact sheet, you can easily see that it's independently calculated and verified. And you can compare the return of that benchmark relative to an inflation plus benchmark over time.
Thanks, Tamryn. Duncan, I'm going to move over to you. A great question from Sean.
How many Seans are there?
No, it's the real Sean. What equips Allan Gray to deliver future alpha in a changing world? If most of your alpha was generated as a smaller asset manager over a decade ago, where most likely smaller mid-cap stock picking was a key contributor. So he's making a few statements about assuming where we invested historically.
Okay, so thanks, Saleem. So it's actually not true. Most of our alpha over Allan Gray's completely long track record has been generated by big shares, actually. And if you think about it, small shares actually become mid-caps, which become large caps when they do well. 2016 was our biggest alpha year ever, money weighted. So it's not like we generated it years ago. But I guess you could say, and even the last 1.5 years have been a strong alpha period. So why do we? If we didn't feel confident, we wouldn't come to work in the morning. We've got a proven track record that's worked for 50 years. A process, a philosophy. We think we've got the right incentives, as Tamryn spoke about, and we think we've got really good, hard, smart working people, not only in the investment team but across the rest of the firm. And the world may be a lot more sophisticated these days. There may be a lot more information out there, but investors make exactly the same mistakes. If you go and read the history books from the 1700s or the 1300s or the crash of 1807, investors make the same mistakes all the time. So having a long-term view allows you to take sort of advantage, sort of a time arbitrage of people who have a lot shorter view. And just like anyone, there's going to be some really good smaller managers out there. We always think that's great. More competition is better for us. But I'll just remind everyone, there are more unit trusts and shares in South Africa. So good luck finding the manager who finds the shares that are smaller that go up. And I think what we would have seen, especially in America over the last while in South Africa, is a lot of the smaller companies are higher risk, right? So when I started my career, at least some of the smaller companies that sort of listed around the time were Aspen, Discovery, Mr. Price. We haven't seen any businesses like that over the last 10 years. So I feel very confident, and that's why we come to work in the morning. But just to reiterate what Tamryn said, performance doesn't come in a straight line. And, when we've underperformed, I like saying we're storing up future outperformance. But, that's what we try to do.
Stay the course. Tamryn, I want to move over to you. It's a great question from Izal. Something close to my heart because I've got parents that are retired, and I know yours are too. And so this is a living annuitant client. And so the question, two parts of the question. So what returns, therefore, risk exposure do I need to sustain being a living annuitant? And then at the same time, she asked, equity markets have been extremely poor. Should I be switching? So it's a investor behavior and something that I've had to coach my parents on myself. I'm sure you two had to do that over the years.
Okay, so look, I think there is when you kind of get to the sort of later years of your life and you've got, 15, 20, 30 years of retirement, you tend to kind of want to de-risk because you want to protect that capital and you want it to grow a little bit, but you don't want to expose yourself to too much uncertainty. And so I would kind of maybe go back to what I was maybe inarticulately saying, is that when you retire at 55 or 60, you've got a long time left still to kind of, for your capital to work for you. So it is important for you to take on enough sort of growth asset exposure. And we would sort of estimate that should be at least 50, 60, 70% to enable you to be able to actually sort of draw down what we think is a reasonable rate, a reasonable drawdown rate over time, let's say 4 or 5%.
Thank you,
if I
Tamryn.
answered all the questions there.
Yeah, and the temptation of switching, moving into equities, or moving out of equities as an annuitant.
it's so the last title of my site said that an investment track record is hollow unless clients stay around to enjoy it. And part of kind of what we see that can be very value destroying behavior is that switching at the kind of worst point in the cycle. And I'll give you a great example, not a great example, it's a bit of a sad example. But if you looked at switching behavior on the platform from 2020, what you could see is that, you know, investors in kind of about March of 2020, when, you know, Duncan was sort of doing a video from Allan Gray and we were saying, look, we're staying the course, and yes, we know it's uncertain out there, but valuations are incredibly attractive. And we know it's nerve-wracking, but stay invested. You know, there was a portion of clients who were switching out of equities into cash. And yes, they did okay for that first month, you know, in March and April when the markets really drew down. But what we find when you switch out of equities at that point in time is that you don't quite know when to switch back into equities. And so they waited, and there's sort of like May they stayed in cash, June. It was only actually towards the end of the year when the equities, kind of when the South African equity market and globally had meaningfully recovered, that you could see the switches sort of coming back in. But actually you'd missed out on a meaningful part of that run. And I think just like a lesson there is it's incredibly hard to kind of time it, because you're sitting there with all those kind of human biases sort of playing into your decision making, and it's impossible for you to tell when is a good time to switch. And which is why we do think a fund like the Banners Fund really helps, because, you know, that's what we pay Duncan for.
Thanks, Tamryn. Question for Duncan from Shoaib Big G. It appears your transaction and brokerage costs are relatively low in the industry. Is this merely due to low turnover or something else?
No, it's due to something else, but yes, part of it's low turnover. So the portfolio roughly turns over once every 4 years, so 25% of the portfolio turns over. So we're not a big trading organization, but, you know, if prices move, we will trade aggressively as prices move. The real reason is, well, one, we've obviously got a lot of buying power given our size. And second of all, something we did which created a lot of value for clients a number of years ago is roughly 2/3 of our brokerage costs on something we call direct market access. So what happens is all the investment banks and stockbrokers, especially the international ones, have written these algorithms that go in and trade into the market. And so we allocate the brokerage to them, not based on their research, right, but actually on their trading execution. And they come in at very, very low rates, like 5, 6, 4 basis points. And what happens is our trading team actually use those algorithms to trade. So we've reduced our trading costs by, we've saved our clients millions and millions and millions of rands over the years from that. And then sort of another 35% of the brokerage, we actually allocate, the investment team allocates, because there's some very smart people who work at investment banks in the sell side who we think can contribute to helping us outperform. And there we would pay a higher rate of brokerage for that research. It's actually a structural reason. The third reason is brokerage rates have come down globally, right? So it's an incredibly competitive industry. Just like our fees come under pressure, the sell side fees have come under pressure as well, and we've just passed that on to our clients.
Duncan, I'm going to stick with you. It's a question from Mr. Michael Hooper, and he's a Orbis Global Equity investor. And he says, look, the 10, 5, and 3-year numbers don't look great, and I think we all agree it's been tough. And he says he's been extremely patient. Why the poor performance, and what's the outlook going forward?
So I think I'll come in 2 ways. Just to remember, Orbis had very good performance up until 2018. In fact, if you had to look like very, very strong performance. So when you're looking at the 5 and 3 year numbers, those are starting to roll off. We would have seen Orbis equities got alpha now over a year. And also alpha versus the average global equity fund, interesting enough, over 3 years. I looked at this today when we were doing some work. But I'll just take you back, Mr. Hooper, to the sort of chart, the second chart I showed, which had central bank balance sheets and the world index. And 60% of the world index is made by the US. And by far, almost everything that drove the US stock market was made up by just the FANG stocks, right? So you've had this endless money printing, interest rates are low. Every time the market falls, there's a Fed put. And all the money that's gone, I'm not sure you're aware, but over 50% of savings that's in the stock market in America is actually in passive now, right? So you've had low interest rates, money going to the markets. And so it's been very, very hard to keep up with the world index. And when we look going backwards now, active managers have actually had a very good year and a half. So if I'm right, I'm not saying I am, if I'm right about what I say the world being different, we think it'll be a far better environment for active stock pickers to go forward. But I mean, I know the Orbis team, they're extremely smart people, they're extremely hardworking people, and you know, a lot of the funds that did very well up until a year and a half ago were invested in all those tech stocks I showed on sort of the third slide over there. So let's see over the next couple of years. But I can tell you one thing, I've been in London twice this year and seen the Orbis team. They're very aware of the negative alpha over 3 and 5 years, and they're working hard to put that right.
Duncan, I'm going to stick with you. Just a quick one in 30 seconds on this. And probably inflation's biting, and we've got Giulio Nardi and Eugene Drosky's asked, how do I protect my savings from inflation?
Okay, so the most important thing about protecting yourself against inflation is to own some kind of real asset, like Tamryn spoke about. So if we look over the last 120 years in South Africa, you've basically got a 1% return after inflation investing in a money market fund. You've roughly got 2 by investing in a bond fund. But you've got 6 or 7, you've actually got higher than that investing in equities, but South Africa's a bit of an outlier. Let's say globally it's 6. The problem with that is it doesn't come in a straight line like that every single year. So the early 2000s in South Africa, the numbers were much higher because stocks were really cheap. I think you got 13, 14 real from shares, but also 3 real versus money. So I think the thing is, it's generally been shown. I think the US dollars lost 98% of its purchase value if you were just sitting in US cash over time. So the important thing is to have some kind of assets that can grow with inflation. Because remember, the equities we own are not a share. They're actually a claim on a business, right, that sells products to clients, and hopefully those businesses can reprice their products, you know, in line with inflation. And I would hope, but it hasn't been the case around the world for a long period of time, that governments are charged a real interest rate, right, for us to lend our clients' savings to them.
Right.
But we understand it's very difficult. And just one last thing, Saleem. I mean, lots of people, obviously, their life experienced inflation is higher than the CPI rate that's quoted officially, because the more your basket is skewed to commodity goods at the moment, or food, those type of things, that inflation is higher than obviously inflation on an iPhone or something.
Tamryn, question for you, more product type question. When will the offshore endowment be available on your platform?
Maybe I'll just quickly explain what it is. So an offshore endowment is, I guess, similar in nature to our local endowment product, in that it is a product that enables us to offer certain, tax advantages, tax efficiencies, and estate planning benefits to clients. So it's essentially a wrapper in which, you purchase this whichever fund you want, or you invest in an underlying fund range, which is available on the platform, and then you invest via this offshore endowment product. So why is it called offshore? It's because you can invest in dollar-denominated or other currency-based funds. So, but to enable us to kind of offer this product on the offshore platform, we've needed to kind of go through various different regulatory hoops and systems developments. So we're in the process of finalizing the setup of an offshore branch of our local life company, and we expect combination of those regulatory approvals and system development to finish, so that we'll be able to offer the product to clients in the beginning of next year.
Thanks, Tamryn. I think we've got time left for one more question. I think this will go to Duncan. Duncan, there's a question. I'm going to combine this question from Peter Loubser, and then we've got a question from Carmen Maynard. And so Carmen's question is, how will we be thinking about investing offshore given the new ex-con changes? And Peter's question is, do we always just invest directly into Orbis? Is that the only manager that we can choose to invest kind of offshore assets?
So if we just come back to the second question, yes, we controlled by the same foundation. We invest sort of all our offshore money with Orbis, other than the money we invest in Africa and frontier markets. Just an interesting fact, our frontier fund is actually the biggest in the world at the moment, but it's only a small portion of the balance fund. So yes, we invest with Orbis. I think what's interesting, hi Carmen, by the way, if you sit there, if we look at it, the one important thing as you look through that top 10 is to say the offshore exposure is much higher than the 34. If we look through Glencore, BAT, British American Tobacco, BHP Billiton, these are all AB InBev, these are all international shares. So the actual offshore exposure is much higher than it is. I would think the sort of more opportunity is to try and look for opportunities where the South African market is not as concentrated. And Tamryn kind of sort of alluded to it. We are working towards a thing where Allan Gray portfolio managers have overall responsibility for the portfolio. So you have one person who can match, should we be in US bonds or South African bonds? What do we think about dollar cash versus investing in British American tobacco? And we will have something on that soon, hopefully. But we think it's very important that one person can look at the portfolio as a whole and judge all these asset classes against each other. I do want to make one statement, though. The worst financial behavior I've seen in my 22-year career is the offshore-onshore thing. People take money off when the rand is weak, buy offshore assets when they're expensive, and they bring money back to South Africa when the rand is strong and South African assets are expensive. And that is one sure way to destroy compounding wealth over time. But we would think through the cycle, we would have close to 40, somewhere between 35 and 40% of the balance fund offshore. Stable will be a lot lower given its absolute benchmark. And the equity fund, somewhere between 30 and 45 will be offshore. So we will take advantage of it. At the moment, there's lots of cheap stuff in South Africa, right? So you don't want to go and sell a South African share that's trading at a 60% discount to buy a US stock that's trading at a 10% discount. But we get in there. It's sort of a trend over time.
Thanks, Duncan.